Hi, and welcome to Janken's Guard on Risk, the YouTube channel dedicated to the theory and practice of risk management. This video is about how do you define risk. And risk so happens to be one of the most abstract and subjective concepts there is, yet we somehow need to agree on some things, in order to be able to measure and manage it in the setting of a company, right? So that is the subject of this video. For more on how to define risk, please check my book, Empowered Enterprise Risk Management. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. So we're going to start with two bedrock sort of fundamental truths about risk, and then take it from there. So the first being that risk is something negative, the possibility of a negative outcome. This is the general understanding of the term risk management today. Negative could be understood in terms of accidents, failures, losses, harm, etc. Something negative, something outside expectations and something outside what we would find desirable. So some deviation from what we would like to happen, essentially. But fundamentally bad, that's the point. So then the other bedrock truth about risk is that it's about as subjective and personal as a concept could possibly get, and it's been said that it's in the eye of the beholder, and I very much agree to that statement. What is a risk to me could very well be an opportunity to you, or at least not a risk. And so it very much comes down to preferences and personal likes and dislikes, and whether we have a risk-loving attitude or so supremely subjective that is. But coming back then to this idea that it's something negative, there are some who would object to that idea, preferring instead to view risk as encompassing both gains and losses, so that we don't separate the two. It's somehow the same thing. And yes, you get losses, but attached to that is some gain or potential for some gain, right? So it doesn't make sense in this view to separate the two. Well, it makes more sense probably to separate between downside risk and upside potential. So they're both going to be part of the picture here, and we're going to take an interest in both. But ultimately, most people will intuitively feel that risk is related to downside, right? Negative outcomes. Whereas we're interested in upside potential. We're going to want to pursue that. And so indeed, to get exposure to upside, you have to accept risk. I mean, that's a meaningful way to look at it, right? That they go together for sure. We're going to never forget that we have to trade off whatever risk we're seeing against some potential upside here. So that's going to be our core philosophy for sure. But it's just that for measurement purposes, and it makes sense to have some measure or idea targeting the notion of negative outcomes, downside risk, and then contrast that to upside potential. So, and as we do this, we are keen on taking certain risks. So risk is not all bad, in the sense that unless you do that, you can't get exposure then to upside potential. And some risks will be better from this in this regard. So that, for example, if you're developing drugs, you're a biotech company of some sort, and you have to take the risk. You have to accept the risk of failure in this development, and that it's not a hit on the market, so to speak. So, but those are essential elements of this business model, and you can't be in that line of business if you're not prepared to. I mean, and that's where you're supposed to excel as well. That's the point here, that you're supposedly very good at that. So you have something to bring. So that's a risk you want to take. Then other risks may be more, side effects of being in that position to pursue that, like exchange rates risk may surface at some point, and that may be completely unintended or sort of and it's not really a value creating risk. But some risks are indeed very attractive to us and must be seen in relation to upside potential. But we're going to distinguish between the two. All right, so having said then that risk is among the most subjective notions there are, then that's a problem in the context of managing risk in an organization, because if we can't sort of measure it and agree on it, how could we manage it successfully? I mean, if we all have different takes on what risk is, we're not going to make a lot of progress in terms of measuring it and managing it. So we have to somehow overcome this subjectivity issue in, and agree on something and move forward with that. But it so happens that there are, apart from what we just said, that you and I could have different risk preferences as individuals. Well, there's reason to believe that there are at least 4 systematic levels in an organization where views on risk systematically diverge. So you have, for example, headquarters with one set of priorities and a certain outlook on life and what's going to be important for the company, etc. So that implies a certain set of risk preferences as well. You have the business units and subsidiaries and all these components that make up the corporate group. Well, they are going to view things from their angle, right? What their priorities are and what they're trying to achieve and their worldview, which is going to be different. So risk to them will also be different. So already we have 2 systematically diverging takes on risk. And then you have the project level within a business unit, where the people forming this unit is now, or quite likely to frame risk accordingly. Like, is the project going to be discontinued? Is it going to be receive further support and funding? That's becoming a very relevant risk in that context, right? So, and then individuals, we're always looking out for our own interests to some degree, and we don't want to be blamed for anything, or set of risks that are unique to the individual. So easily 4 different levels of risk, and they are, risk is going to be different in all these different places. So even within an organization, we're bound to find different definitions of risk. So starting out, we can be quite sure that the issue of subjective notions of risk is going to be around in companies. We can expect that. But we're going to try to, amidst all this, plurality, we're going to try to find certain common themes, that we typically see when we are in organizations or deal with them, that this is how they, in one way or other, think about risk. So we're going to explore that a little bit. So the most, the first to consider is risk as a financial loss. I mean, that comes with the territory when you're doing business, like losing money. And another way to conceptualize risk in the context of a firm then is in terms of not achieving goals. Companies set goals for themselves, and what if there's a risk of not achieving that, or some threat that causes you to not achieve it? That's one way of conceptualizing risk as well. And then there's this view that it's any company has a set of critical benchmark levels of performance it needs to meet. They're critical in some sense that if you fail to meet it, you're in for some trouble. There will be a negative consequence. Like these are pretty hard sort of thresholds. So that's another take on risk. You have to stay out of the trouble that comes from failing to meet these threshold levels of performance. So let's elaborate a little bit then. So risk as a financial loss, it could be as simple as losing money that we have invested in a venture. So we put a lot of money on the line, but we have to accept the risk that we could lose it. Let's say that there's been an investment of 200 million made in a venture. Maybe we could stand to lose it all. That's a risk we may have to live with. And corporates could easily think of risk in this way, or relatedly as some negative impact on the margin, like some operating margin where, which takes a hit if a certain risk materializes, and that could be a major risk perspective in companies, right? Because business has to do with that sort of thing to such a high degree. So it becomes natural to see risk in those terms. Alternatively, that earnings could fall by more than 300 million next year. We're working with a composite measure here of corporate performance that adds up a lot of individual activities. Well, if you look at that performance number, you know that it could drop by a certain amount, and that could be a terrible thing as well, or be come across as highly undesirable and a risk. Then, so that's another way to define risk in firms. So then we have risk as not achieving goals, which is when we set up goals for ourselves as part of motivating people, right? We have a very commonly we see companies set ambitious targets for the next year or the budget period, right? And then the business units strive to achieve that, and individually as well, we set up goals like these KPIs. And well, risk could be understood then as deviating from that goal. You fail to achieve the goal. There's a certain risk of that always, you know, and you might frame it that way. So let's say there's an 8% growth target, you know, and you desperately want to achieve it because you know that would signal progress, and you know you're in for some variable pay here, some bonus, or that the operating margin falls below a certain target, say 10%. So you have in this case a margin target. So it could very well be perceived as a risk to not meet that. It would entail a negative sort of outcome, right? So that's another possibility, defining risk in terms of not achieving goals. And then we have the risk as not meeting critical thresholds of performance. So let's say that a bank has imposed some covenant or so that EBIT interest should be 3, or downgraded here in this example where the company is rated by a rating agency, and they are likely to downgrade a firm if that threshold was breached for a sufficiently long period. Then you could frame risk along those lines. And then the loan covenant example where what if it's triggered and the loan agreement stipulates that in that case you're required to sell assets, and maybe you don't want that. Maybe you think that your future success is, you know, depends on you being able to continue to run your business as you see fit. And so that's another way. These are more hard thresholds of performance, and to put some more flesh on that idea, you know, let's say you're investing 300 million next year. That's the ambition. Those are value creating investments you would like to take. But the bank is only willing to lend you 150 million for various reasons. They are disinclined to extend you more credit than that. So meaning that the gap, the difference, has to be covered by your cash flows. So you now have a critical threshold of performance. If you fail to reach that cash flow threshold, you can't invest according to plan, right? So that's another, you know, tangible threshold that implies a negative consequence. In contrast to goals, which are aspirational, and that's a crucial distinction here, meaning that we hope and aspire to achieve them. We would love for that to happen, and we're going to be disappointed whenever it doesn't happen, right? So, but that's something different. These are not hard thresholds in the same way, and they're not obviously connected to real consequences. Disappointment and frustration is one thing, but real consequences are something else, much more serious. And the point here would be that in many cases, these thresholds are linked to the value creation process. So that if you fail to meet them, your covenant is breached, or your rating goes down, or your investment program is not funded, that's a disruption to the value creation process. You're not going to be able to execute your strategy optimally. So there's value being destroyed there, most likely. And that is not as easily said about goals, you know, because of their aspirational nature. So here we're probably going to prefer them because of it's defensible from the point of view of creating value. And we do find, however, that in practice, this view of risk as not reaching goals is quite widespread. Many people have that tendency to, as soon as you define a goal, risk becomes deviation from that goal. And because of what I said before, that so many firms operate with this model of management, where, management by objective. So you're constantly setting these targets, and key performance indicators are all over the place today. Everyone has one, it seems. And so the upshot is that it's a very powerful tool or thing, this goal setting apparatus. And whenever you decide then on a goal, you automatically decide on what is risk, because it becomes deviations from that. So this is an important observation, because it means that we control more or less how people will perceive and define risk by setting our targets. The way we do that will ultimately mean something for how people look at risk. So, for example, if you set them very aggressively, so that people are behind the targets, they have to, make a major improvement. They are going to love risk because they are desperate to get to there, And if taking higher risks is necessary, well, so be it. You have to try to reach a target. So that could imply more reckless behavior, right? Whereas if you're already on the right side of your goal, you've managed to get there, but some time is remaining, well, you're going to protect the goal. And you are risk averse now. You maybe even hate risk and would like to use a lot of resources to avoid further risk. So look at how powerful the whole thing is, but the best case then from the point of view of theory, at least, is the risk as critical threshold view on it. That's the best case because it's intuitively all right. We find it reasonable to think of risk in those terms. It's not hard to be convinced of the relevance of protecting against those outcomes. But it's also aligned with the theories for how risk management creates value. So you can connect various negative outcomes to the theories we have for how risk management creates value. They're actually quite close in many cases, and that's a pro. That's makes it more legit to engage in risk management and use resources for that purpose. All right, to sum up this video, we have that it is the mother of all abstract concepts here and a supremely subjective experience. But broadly defined, we can say that it's the possibility of an undesired outcome. It's a negative consequence. And we need to also conclude and take away from here this discussion that goals have a profound effect on how risk is defined and understood in firms, because it affects their incentives, what they're going for, and how much they need to gamble to get there. And so that's going to be very important to consider, that we control the definition of risk to a great extent through those means. All right, and the most robust definition of corporate risk would be the failure to reach a critical threshold, which is then linked to the value creation process. If you fail to reach the target threshold, it implies that you're not executing your strategy optimally. So that is pretty robust definition of corporate risk. But realistically, we're going to see all three of them at any given point in time in pretty much all firms. So they're coexisting. So it's more a matter of emphasis and than choosing one over the other. All right, thanks for listening, and please check out my books on risk management. There's more information on the webpage. Please like and subscribe, and thank you, and have a good day.